this time gold and silver would outperform because I think people have to come to the realization that the Fed can't stop inflating. And if they come out again and save the system because of a repo crisis, I think people might wake up and say to themselves finally, well, this is never going to stop, which is what I've been expecting for ever since really the '08 crisis. A deflationary collapse, though, would also help gold and silver because you'd see a lot of bankruptcies, banks and everything else, a dearth of dollars, if you want to call it, fiat currency. But gold and silver would also be pretty much in demand.
The Federal Reserve's balance sheet grew from $0.9 trillion in 2007 to $7.3 trillion by May 2024, with spikes in 2008 and early 2020 due to the financial crisis and the COVID-19 pandemic. This led to negative GDP growth, which prompted the Fed to adopt expansionary monetary policies to boost employment and economic growth. According to Mario Innecco of MarioInnecco 64, continuous money printing has historically led to either a deflationary collapse or a currency crisis. Roy Jastram's book, The Golden Constant, identifies three major periods of deflation: 1814 to 1830, 1864 to 1897, and 1929 to 1933. During these times, gold maintained its value. For instance, in 1896, gold could trade for 80% more commodities in the UK than 20 years earlier. Mario Innecco suggests that in a deflationary collapse, demand for gold and silver rises due to bankruptcies and fiat currency scarcity. If this happens, gold and silver could become crucial as viable payment methods. Eliminating paper cash, as Kenneth Rogoff proposed, would make gold and silver the most marketable physical currencies. During the pandemic, the U.S. Federal Reserve injected approximately $3 trillion, expanding its balance sheet from $4.16 trillion to $7.17 trillion from March to June 2020. By April 2022, it grew to around $9 trillion due to Biden's Inflation Reduction Act, which aimed to provide a COVID-19 stimulus through monetary expansion. Innecco notes that in early 2020, the Fed increased the money supply due to COVID-19. Now, concerns about a repo market crisis could lead to further liquidity injections through QE, potentially boosting stocks, bonds, gold, and silver, but weakening the dollar. Join us as we delve into Mario Innecco's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
The repo market is a market where financial institutions provide liquidity to each other using treasuries as collateral. But if the treasury is in need of liquidity to keep going and in need of borrowing, hundreds of billions, it crowds out that private sector funding market, which is the repo market. And they warned about that. And we saw in 2019, in September 2019, that's what that happened again. The Fed was doing quantitative tightening, the balance sheet was unwinding, and all of a sudden, financial institutions stopped trusting each other. They wouldn't even lend to each other if they had treasuries as collateral, and the repo rate went from like around 2.5% to 10%. And then the Fed had to step in, and they stopped. Well, they said it was not QE, it was just to provide liquidity, but they stopped the QT after that. And then the following year, early in the year, we had that COVID crisis, which was a good cover for them to pump even more trillions into the system. So yeah, that's something that I hadn't heard up until recently, maybe a problem with the repo market. And it looks like Wall Street is worried about that. So if Wall Street is worried, I think we need to, take note.
What kind of impact do you think a crisis in the repo market would have on the average investor out there?
The impact would be that the Fed would have to come in again. And, normally they would provide liquidity by doing more QE. So it probably would actually boost everything again, stock market, bond markets, gold, silver. and the dollar would be the main loser. And it would be more. I think this time gold and silver would outperform. The Fed can't stop inflating, and if they come out again and save the system because of a repo crisis, I think people might wake up and say to themselves finally, well, this is never going to stop, which is what I've been expecting for ever since the 08 crisis, because historically that's what happened when you go down the route of money printing. Unless you let it all implode and collapse into a deflationary depression, you have to keep going. And eventually that collapses also into a currency crisis. A deflationary collapse, though, would also help gold and silver, because you'd see a lot of bankruptcies, banks and everything else. And you'd see a dearth of dollars, if you want to call it, fiat currency. But gold and silver would also be pretty much in demand, because no one would have any currency, because the Fed, if the Fed and the Treasury allows everything to implode. And I don't think they're going to do that, though. I think they're going to go the route of more and more monetary and fiscal stimulus when they see the first signs of trouble.
In recent months, gold and silver saw all-time highs in April and May, but Innecco observes a current consolidation phase in their prices. Gold is trading within a narrow range of $2,300 and $2,350 per ounce, with August gold futures closing near the day's low, down 0.57%. In contrast, silver has shown weaker performance, with July silver futures trading at $28.915 per ounce, down 2% for the day. Analysts attribute silver's sensitivity to movements in the US dollar, which has recovered following recent declines. Mario Innecco emphasizes the long-term significance of holding physical gold and silver, advocating for consistent accumulation despite short-term trading dynamics. Analysts foresee gold and silver remaining range-bound as traders exercise caution ahead of Friday's Personal Consumption Expenditures Index report. Although a rate cut would benefit silver, if the U.S. central bank is forced to cut rates because the U.S. economy is slowing, that could weigh on the precious metals' industrial demand. Let's get back to the interview.
I think there's a couple of things. The first thing is that they've turned precious metals, or it's been like this for decades. People speculate on gold and silver through the futures and over the counter like a currency. And there's always this volatility, which puts a lot of people off from buying physical gold and silver. So I think it's a trading game, but eventually you want to have gold and silver. You have to keep stacking. What we see day to day is speculators and bullion banks in the paper market, trading. But I think gold and silver had done really well, like from April to May, and they picked up very quickly. So they got ahead maybe of themselves. And what I'm seeing now is consolidation, so we can so that the moving averages can catch up with the prices. And silver, the long-term charts look quite bullish, and I think by the end of the week, if we're still above, let's say, 28.30 or thereabouts, it still looks very, very good. And don't forget, gold, I think, settled last year at 2,060. So we're still doing really well. And you're always going to have some kind of corrections in the bull market. And that's how I see it. And I think also seasonally, July is a good month for precious metals. So, but I always, when I get frustrated with the price moves in paper, gold and silver, I always tell myself, what's the alternative? Am I going to get rid of my gold and silver and put it with JP Morgan or Goldman Sachs or NatWest or Barclays? No, I'm not going to do that. So I just keep keep going.
The dynamics of gold and silver continue to intrigue investors amidst economic uncertainties and central bank policies. Gold's narrow trading range reflects cautious market sentiment, while silver's performance remains sensitive to fluctuations in the US dollar and industrial demand expectations. As we anticipate upcoming economic data, including the Personal Consumption Expenditures Index report, analysts suggest both metals could remain range-bound in the near term. What factors do you think will significantly impact gold and silver prices in the coming months? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.